Something changed in the silver market. Not something small, not something to brush aside or explain away with a single headline. In a single trading session, silver experienced one of its most violent price crashes in modern history. The kind of move that sends charts vertical in the wrong direction. The kind of move that forces even experienced traders to pause and reassess. If you hold silver, you felt it. If you've been watching from the sidelines, you noticed it. And if you're like most people trying to make sense of financial markets in 2026, you're probably asking yourself, what just happened and what does it mean? This video is not about panic. It's not about telling you to buy or sell. It's about understanding. Because in moments like these, when price action becomes extreme and headlines become breathless, the difference between wealth preservation and wealth destruction often comes down to one thing: whether you understand what you're looking at. I'm going to walk you through this event the way a clear-headed analyst should. We'll examine what happened, why it happened, what the broader forces at play really are, and most importantly, what it means for your financial decisions going forward. Whether you own silver or you're considering it, whether you're new to precious metals or you've been holding for years. By the end of this video, you won't have a crystal ball. No one does. But you'll have context, you'll have framework, and you'll be better equipped to think through what comes next without letting fear or greed make your decisions for you. Let's begin. First, the facts. Silver prices dropped more in a single session than they have in decades. We're talking about a decline that exceeded 15% in hours. For an asset that trades globally, that serves both industrial and monetary functions, and that typically moves with some degree of predictability relative to gold, this was extraordinary. The immediate aftermath looked exactly how you'd expect. Headlines everywhere. Social media flooded with reactions ranging from celebration to despair, traders liquidating positions, margin calls forcing exits, and of course, the inevitable flood of opinions about what it all means. But here's what's important to understand right away. Extreme price moves in silver are not new. This metal has always been volatile. It's smaller than the gold market. It's more thinly traded in certain time frames. And it swings harder in both directions. If you've studied silver's history, you know this already. If you haven't, you just learned it the expensive way. What makes this particular crash noteworthy isn't just the magnitude, it's the context. Because this didn't happen in isolation. It happened at a moment when global debt levels are at historic highs, when central banks are navigating impossible choices between inflation control and economic growth, when geopolitical tensions are reshaping trade and currency relationships, when the entire architecture of the post-2008 financial system is being stress tested in real time. So yes, silver crashed. But to understand why and what it signals, we need to zoom out significantly. Because the price of silver on any given day is not the story. The story is what that price is telling us about much larger forces in motion. Let's establish some baseline reality about the economic environment we're operating in. Because nothing that happens in markets happens for one reason. Everything is connected. Everything is feedback loops and second-order effects and competing forces pushing against each other. Start with debt. Global debt, both public and private, has reached levels that would have seemed unimaginable 2 decades ago. Governments around the world have spent years borrowing to fund stimulus, infrastructure, social programs, and crisis response. The pandemic accelerated this dramatically, and now we're living with the consequences. When debt grows faster than productive economic output, something has to give, either through inflation, which erodes the real value of that debt, or through austerity, which contracts economic activity, or through default, which destroys confidence in the system itself. There are no other mathematical outcomes. Central banks have been trying to thread an impossible needle. They raised interest rates aggressively to fight inflation, but higher rates make existing debt more expensive to service. They also slow economic growth, which reduces tax revenue, which makes debt problems worse. It's a trap with no clean exit. At the same time, currency dynamics are shifting. The dollar has been under pressure from multiple directions, not because it's about to collapse, but because the world is slowly, carefully, deliberately reducing its dependence on dollar-denominated trade and reserves. This process takes decades, not months, but it's happening. And it matters for everything priced in dollars, including precious metals. Inflation itself has been more persistent than forecasters expected. The official numbers tell one story. The lived experience of people buying groceries, paying rent, and filling gas tanks tells another. This gap between official inflation metrics and real purchasing power erosion is one of the reasons people turn to alternative stores of value in the first place. And finally, investor psychology. Markets are not machines. They're crowds of humans making decisions under uncertainty, often with imperfect information and emotional biases. When sentiment shifts, especially in smaller, more volatile markets like silver, price action can become extreme very quickly. All of this is the backdrop. All of this matters because the silver crash didn't happen because of silver fundamentals alone. It happened because all these forces converged in a moment of maximum stress and uncertainty. Now let's talk about how crashes actually work, because understanding the mechanics helps you avoid making the mistakes that destroy capital during volatile periods. When an asset price rises significantly, especially quickly, it attracts different types of participants. Some are long-term holders who've done their homework and believe in the thesis. Some are momentum traders who buy because price is going up. Some are speculators using leverage to amplify returns. And some are simply following the crowd because they don't want to miss out. Each of these groups has different pain thresholds, different time frames, different reasons for being there, and when price starts falling, they don't all react the same way. The leveraged speculators are the first to go. Margin calls force liquidation regardless of whether they want to sell. This creates selling pressure, which pushes price lower, which triggers more margin calls. It's a cascade. And in a market like silver, which isn't as deep or liquid as stocks or bonds, these cascades can become violent. Next come the momentum traders. They have no conviction about the underlying asset. They were there for the ride up, and they'll exit the moment the ride turns around. Their selling adds to the pressure. Then the fear spreads to less experienced holders. People who bought in because they heard it was a good idea, but never really understood why. When they see their positions down 20, 30, 40%, panic sets in. They sell at exactly the wrong time, locking in losses they could have avoided with patience and understanding. The long-term holders, the ones who understand what they own and why, are the ones who stay calm. Some even buy more. Not because they're trying to catch a falling knife, but because their thesis hasn't changed and the asset just got cheaper. This pattern repeats in every market, in every cycle, in every asset class. It's not unique to silver, it's human nature colliding with market structure. And if you understand it, you can avoid being the person who panic sells the bottom. Silver has always been this way. If you look at historical charts, you see the pattern repeated over and over. Periods of stability followed by explosive moves higher, then sharp, brutal corrections that shake out weak hands, then consolidation, then another cycle begins. In 1980, silver briefly touched $50 an ounce before collapsing. In 2011, it ran to nearly 50 again before getting cut in half. In 2020, during the pandemic uncertainty, it doubled in months before pulling back hard. Now, these aren't anomalies. They're features of how this market works. The reasons change, the players change, the narrative changes, but the pattern doesn't. Silver attracts speculation because it's volatile. And it's volatile because it attracts speculation. It's a self-reinforcing loop. What matters for you as an investor or holder is recognizing where you are in the cycle. Because the same volatility that creates these crashes also creates the opportunities that bring people to silver in the first place. You can't have one without the other. The investors who've done well in precious metals over long time frames are the ones who understood this going in. They didn't expect smooth, linear appreciation. They expected chaos. They expected gut-wrenching drawdowns. They expected moments exactly like this one, and they prepared accordingly. That preparation isn't about market timing. It's about position sizing, risk management, emotional discipline, and time horizon. If you're holding more silver than you can afford to see drop 50%, you've already made a mistake. If you're planning to need that capital in the next 6 months, you've made a different mistake. If you're basing your financial security on short-term price movements in a volatile commodity, you've made the biggest mistake of all. The historical lesson is simple. Silver rewards patience and punishes impatience. It rewards education and punishes ignorance. It rewards discipline and punishes emotion. That's been true for 50 years. It's probably going to be true for the next 50. So you're holding silver right now. Your portfolio just took a hit, maybe a significant one. Let's talk about what you should be thinking. First, revisit your thesis. Why did you buy silver in the first place? If you bought it because you believe fiat currencies are being debased and you want to hedge against that process, has that thesis changed? If you bought it because you believe the debt to GDP dynamics of major economies are unsustainable, has that changed? If you bought it because you want uncorrelated exposure to financial assets, has that changed? If your thesis is intact, then the price drop is noise. Painful noise, certainly, but noise nonetheless. You didn't buy silver to trade it, you bought it to hold it, and holding means tolerating volatility. Second, check your position size. Are you overexposed? Is this drop causing you real financial stress or just emotional discomfort? There's a critical difference. Emotional discomfort during volatility is normal and expected. Financial stress means you've allocated too much capital to a volatile asset. If it's the latter, this might be an opportunity to rebalance, not out of panic, but out of proper risk management. Third, ignore the short-term noise. The headlines will be dramatic. The commentary will be extreme. People who've been predicting silver's collapse will claim vindication. People who've been bullish will offer explanations for why this is temporary. None of it matters to your long-term outcome. What matters is the structural case for holding some portion of wealth and assets outside the traditional financial system. That case hasn't changed because of one day's price action. If anything, the forces driving people toward alternatives like precious metals have intensified, not diminished. But here's what you should not do. Don't double down out of anger or stubbornness. Don't buy the dip just because it's a dip. Don't convince yourself this is definitely the bottom. Don't let loss aversion drive you to take more risk to make it back. These are all psychological traps that turn manageable losses into catastrophic ones. If you're going to add to a position after a crash like this, do it systematically. Do it in small increments. Do it with capital you can genuinely afford to lose. And do it because your analysis says it makes sense, not because your emotions demand it. Now let's talk to those of you watching from the sidelines. Maybe you've been interested in silver but haven't pulled the trigger. Maybe you sold before the crash and you're feeling vindicated. Maybe you've never owned any, but you're curious about what this all means. First, understand that market crashes often create opportunities, but they don't always create immediate opportunities. Just because an asset dropped 15% in one session doesn't mean it won't drop another 15% over the next month. Trying to perfectly time the bottom is a fool's game. If you're interested in silver as part of a diversified portfolio, events like this are worth studying. They teach you about the asset's behavior. They show you how it trades under stress. They give you a sense of whether you can psychologically handle owning something this volatile. Because here's the reality. If watching silver drop this hard makes you excited about potential opportunity, you might have the temperament for it. But if watching it drop makes you think, I'm glad I'm not in that, then you probably shouldn't be in it at all. Know yourself. That's more important than knowing the market. Second, don't assume that because silver crashed, the case for precious metals is dead. Markets are not that simple. Sometimes crashes are warnings of worse to come. Sometimes they're capitulation events that reset sentiment and create bases for future strength. Sometimes they're just noise in a longer trend that hasn't changed direction at all. The macro factors that drive interest in precious metals, factors like currency debasement, unsustainable debt, geopolitical instability, and distrust of institutions, haven't vanished because of one day's price action. If those factors matter to you, they should still matter. If they don't matter to you, then silver probably isn't the right holding regardless of price. Third, if you're going to enter, do it with a plan. Not a get-rich-quick plan, a real plan. What percentage of your portfolio? What's your time horizon? Under what circumstances would you sell? How will you respond to volatility? If you can't answer these questions clearly, you're not ready to own silver, period. And understand that silver is not an investment in the traditional sense. It doesn't pay dividends. It doesn't generate cash flow. It doesn't have earnings growth. It's a monetary metal with industrial applications, and its price reflects a complex mix of supply, demand, speculation, and monetary concerns. You hold it as insurance, or as a speculation on currency debasement, or as a diversifier. You don't hold it expecting Amazon-like returns. Let's talk about the mistakes that wipe people out during market stress. Because the difference between people who survive crashes and people who don't usually comes down to avoiding a handful of critical errors. Don't panic sell. This is the obvious one, but it's worth stating clearly. Selling at the bottom because you can't handle the emotional pain of watching your position decline is the surest way to turn a temporary paper loss into a permanent realized loss. If you bought silver for long-term reasons, those reasons don't change because of short-term price action. Don't over-leverage. Using borrowed money or derivatives to amplify your exposure to any volatile asset is a recipe for disaster. The people who got completely wiped out in this crash weren't the people holding physical silver, they were the people using leverage, trading options, or holding positions they couldn't sustain when margin calls came. Don't chase headlines. Every crash produces an avalanche of commentary. Some of it will be intelligent analysis. Most of it will be reactive noise designed to generate clicks and engagement. Your job is to filter signal from noise, and that requires patience and skepticism. Don't make major financial decisions based on what you read in the hours immediately following a volatile event. Don't abandon your strategy. If you had a plan before the crash, stick to it. If your plan was to accumulate slowly over time regardless of price, keep doing that. If your plan was to hold long-term and rebalance annually, keep doing that. Markets reward consistency and discipline. They punish impulsiveness and emotion. Don't fall into the "this time is different" trap. When silver is soaring, people convince themselves it's going to $1,000 an ounce. When it's crashing, people convince themselves it's going to zero. Neither is true. History doesn't repeat exactly, but it rhymes. And the rhyme suggests that silver will do what it's always done: be volatile, frustrate both bulls and bears, and ultimately reflect the broader health and trust in the global monetary system. And finally, don't isolate yourself in echo chambers. If you only consume content from people who are ultra bullish on silver, you'll develop a warped view of reality. If you only consume content from people who mock precious metals holders, you'll develop an equally warped view. Seek out intelligent disagreement. Test your thesis against smart critics. Stay intellectually honest. Step back for a moment. Zoom out. Look at the entire landscape, not just the crater in front of you. We are living through a period of extraordinary monetary and fiscal experimentation. Central banks have expanded their balance sheets to levels that would have been unthinkable a generation ago. Governments have normalized deficit spending that used to be reserved for wartime. The entire global financial system is built on layers of debt that may or may not be serviceable, depending on 1,000 variables nobody can predict with certainty. In this environment, assets like silver matter, not because they're going to make you rich overnight, but because they represent something outside the system. They're tangible. They're no one else's liability. They can't be printed into existence or defaulted away. That doesn't make them perfect. It makes them useful in a diversified approach to wealth preservation. The crash you just witnessed is part of a much longer cycle. A cycle that includes periods of euphoria and periods of despair, periods of accumulation and periods of distribution, periods where everyone wants exposure and periods where everyone wants out. Your job as an investor isn't to predict exactly where we are in that cycle. It's to recognize that the cycle exists, that volatility is inherent to it, and that your success depends not on timing but on patience, discipline, and risk management. The investors who build lasting wealth don't do it by perfectly timing markets. They do it by understanding what they own, knowing why they own it, sizing positions appropriately, and having the emotional fortitude to withstand periods exactly like this one. So here we are. Silver just experienced one of its worst single-session crashes in modern history. The headlines are dramatic, the charts are ugly, and everyone has an opinion about what it means. But you're still here. You're watching this video because you want to understand, not react. You want context, not panic. You want to make informed decisions, not emotional ones. That puts you ahead of most people. The truth is, nobody knows what silver will do tomorrow or next week or next month. Anyone who tells you they do is either lying or deluded. What we can know is that extreme volatility in assets like precious metals is normal, that market crashes create both risks and opportunities, that the macroeconomic forces shaping our world haven't suddenly resolved themselves, and that your response to events like these will determine your long-term outcomes more than the events themselves. If you hold silver, hold it with conviction or don't hold it at all. If you're considering silver, do so with clear eyes and appropriate position sizing. If you've decided it's not for you, that's perfectly fine. Not every asset belongs in every portfolio. What matters going forward is that you stay informed, stay disciplined, and stay rational. The financial landscape is changing. Some of those changes will be painful. Some will create opportunities. Your ability to navigate it depends not on perfect predictions, but on sound principles. Keep learning. Keep questioning. Keep your position sizes reasonable, keep your time horizon long, and keep your emotions in check. The crisis might be here, but if you understand what you're looking at and why, you're better positioned to handle it than the vast majority of people watching markets today. Stay calm, stay disciplined, and stay thoughtful. Thank you for watching.